This is 2025 FOREX TRADING EMPIRE Mentorship Program Lecture 19. The topic for this lecture is weekly counter trend candle. In the previous lecture, we talked about weekly reversal candle, weekly trend continuation candle. We talked about how to identify the lower time frame trend, which is the 4 hour, when using a weekly bias. Which in every individual week, we're trying to define the candle to know on which trend we should focus on which trend we are anticipating price to trade on. So on a weekly counter trend candle, it's like a weekly reversal candle, but we are trading against the underlying weekly bias. In a situation where price is on a downtrend or on an uptrend, and price run out the previous high or previous low, and we are anticipating price to trade back to a premium or a discount, we'll be using a counter trend strategy or trade plan to anticipate a retracement back to a weekly reference point or weekly fair value gap order block. So understanding the weekly counter trend and how to trade the weekly counter trend, you need to understand previous week high, previous week low is very important because for you to anticipate price to retrace back to a weekly reference point, you need to see some sort of confirmation. You need a confirmation of price running out either the previous week high or the previous week low and anticipating a shift in market structure after the run on the high or the low. So we're going to go to the chart to show up some example. On the weekly time frame of Euro USD, price traded lower, retracement, fair value gap led to lower prices. Retracement, price respected this, fair value gap led to lower prices. Now, if price were to do a retracement back to a reference point with the next draw on liquidity will be this order block or price trading to this liquidity void, weekly liquidity void now. Here are the next draw on liquidity, and price is nowhere close to the next draw on liquidity. And price have been trading lower. Price took out sell side liquidity, and price is currently at this fair value gap from the weekly past price. Price is at the fair value gap. Now, trading a counter trend, if price were to do a retracement back to this reference point, where will price? What are the characteristics of price for price to lead to higher prices doing a counter trend? Because this is trading against the underlying bias. The underlying bias is that price on a downtrend, price respected this fair value gap led to lower prices. If you were to look for a retracement back to this reference point, this liquidity void and this sort of block, it will be a counter trend. And a counter trend is, when it comes to my strategy due to back testing, it will have a low probability of giving you the right entry at all time. Some of my losses, I can say most of my losses do come from a counter trend because sometimes price just keep trading down and I'm trying to catch the retracement, try to get the retracement. So I did apply some few rules that I need to see price run the previous candle's high and low, or price to run the previous candle low in a scenario where I'm anticipating a retracement back to this liquidity void, which means I'm looking for an uptrend. I would like to see price run the previous week low, then a 4 hour shift in market structure. Then I follow the trend, not anticipating a complete retracement to the liquidity void. There are many cases the price will just retrace a few and lead to lower prices. I'll be sticking to that trend, but as long as there's a little shift in market structure from that trend, then I will hold up in my trading on that week. So first, I want to see where price run at the previous week low, then a retracement back to the weekly range. Run on the previous week low, retracement back to the weekly range. Now, from the price of price running at the weekly low, I'll be looking for a 4 hour shift in market structure, looking for a quick trend, targeting a 4 hour reference point at the left hand side to look for a quick trade. I can say in most cases, you just look for a simple 1 to 3, 1 to 2, or at max 1 to 2. But don't go below 1 to 2. It goes against the probability of a higher win, of a higher risk to reward. So let's go down to the 4-hour time frame. Now on the 4-hour time frame, here's the previous week low. You can see this week came lower, traded below this week, and here's the previous week low. Let's adjust it. So price run at the previous week low, did a shift in market structure, running out this auto block because the two down close candle is another block. Price run at the two down close candle, did a shift in market structure, running out this high. Now, price have shift structure from the 4-hour downtrend. You can see the 4-hour downtrend. Price have shift structure. Now, after the shift to structure, where is going to be the next draw on liquidity? Price already traded through this fair value gap. The next draw on liquidity will be this liquidity price pool. This is like a trend line liquidity, but here's a liquidity. You can see how price stock accumulated. Price only took out the low of the accumulation within this phase. And the next draw on liquidity will be this fair value gap above this high, which will be the next draw on liquidity. Make sure you identify your next draw on liquidity before going into lower time frame to look for entry on the retracement on the 4-hour time frame, retracement to fair value gaps or the block. So the first retracement was to this fair value gap. Let's make it blue. Retracement to this fair value gap led to higher prices. Retracement fair value gap, price traded to our target and fill the fair value gap. So we are looking for price to fill the fair value gap, not to respect the fair value gap. It's just like a storming block that you want to close your trades or close some position as soon as price trades and fill the fair value gap. Now, we'll be applying it the same way we used on the previous lecture on defining the weekly trend. I'm going to be focusing on the specific times in which we talked about the 3 a.m. to the 4 a.m. entry model, and we're talking about the New York section, applying it correctly if you were to look for your entry specifically during those times. So let's turn the section indicator and we look at each section from on Tuesday. So price used Monday to that led to the shift in market structure. Tuesday did a retracement to the fair value gap, and Wednesday did the last trend to fill the fair value gap from the left side of the chart. And after the retracement to the fair value gap, after price filled the fair value gap, price did a little shift in market structure. We don't call it a good shift in market structure, just an impulsive candle showing that price have shifted the trend. But in most cases, price will fail to create a low after this impulsive move and might just lead to higher prices. But days we're focusing on is going to be the Tuesday and the Wednesday because those are the days where price kept trading higher, and we look on how price did the retracement lower to run out the previous low to shift the market structure. So first, let's go to the 5 minutes and look at the specific time. We'll start from Tuesday. Remember, counter trend is the most complicated one among those three candles. I think trend continuation and trend reversal. Trend continuation is the easiest. Trend reversal is the mid when it comes to how difficult it is to spot it. If you be more patient about it, you can identify those trades. Because if you're just waiting for a 4-hour shift in market structure, like we waited, like how price did shift structure on the 4-hour time frame on this counter trend trade. But the counter trend is the most complicated one because there's going to be a whole lot of accumulation on some phases. So most of your losses is going to come through this counter trend trade. But if you practice it enough and backtest, do your own journaling, understand where you have the best probability of price playing to your trading to your direction, then I think you can walk your way through this because I trade the counter trend all times. I trade the counter trend. I think I've gotten most of my big wins from the counter trend because I mostly aim for a higher risk to reward around 1 to 5, 1 to 6, and above, due to the fact that it has a low probability of price respecting the fair value gap. Sometimes price might just keep on trading lower or keep on trading higher. So first on Tuesday, price retracement to this fair value gap, tested the fair value gap during the Asian section. Price kept on trading, kept on trading. Now getting to 3 a.m. So here's our trading period. Okay, here's 3 a.m. 3 a.m. to 4 a.m. Let's make this red and calling it the 3 a.m. 3 a.m. to 4 a.m. So here's our time range to look for our entry. Now, but during this time range, price traded higher, left the fair value gap, which would have been your entry level. This would have been the entry. Price retraced back to the fair value gap, respected the fair value gap, but failed to create a new high, traded lower, took out the low, did a few consolidation. Now, on Tuesday, there was a high impact news. You can look at it on the 14th of January. There was a high impact news on the 14th. It was on Tuesday. There was high impact news. So, since there's a high impact news, I wouldn't be taking any trades after 8:30. Remember, always apply the rules correctly. So, price traded back, stopped us out. So, really, this would have been a losing trade. So, let's indicate it. This would have been a losing trade. So price traded lower, stopped us out, came back to the fair value gap. Now price traded back to the fair value gap. We are looking for an entry after 8:30. Price did a few consolidation. 8:30, price did a shift in market structure with this impulsive candle. Now this would have been an entry. 1, 2. This auto block would have been your first entry to execute on. But if you choose to use a fair value gap for your entry, you can still wait for price to from the fair value gap, which I'll be pointing out. So auto block, this would have been your first entry after 8:30, price is an impulsive move. Retracement back to the other block, respected the other block. Now within that price range, here's the fair value gap. Price respected the fair value gap, led to higher prices, and price kept trading. There's another entry at this fair value gap. So you can see price gave up the whole opportunity during the New York section. If you were to execute this trade correctly, this would have been a very nice trade. And how far would price retrace higher? You just, I've talked about it many times on how to measure it. You just look from the recent swing low, from the retracement, you measure the retracement, and the 50% level will be your first target, and the 100% level will be your second target. And you can see how price traded to the 50% level, kept trading higher the next day, traded to the 100% level. That is how far would price trade higher. I think we done it on the previous lecture. So if you had to take either of these entries, the 50% level and target the 50% level, your first trade will be the other block. You might just execute on one of these entries and use the rest to manage your trade or to accumulate more position. And this is a 3.5 hour trade. At the 50% level. Now, mostly I would target the 50% level because we are close to the end of the London section at 12. I don't want to be holding any position after 12. I don't normally hold position after 12 because in most cases price might do a retracement back to the daily range, and I don't want to be in that market seeing a retracement back to my profit. So I rather look for a quick target, which is a 3.5 at the 50% of this retracement, and price trade to that area. Now on Wednesday, so I did not mark out the fair value gap on the 4 hour time frame. So let's go back to the 4 hour time frame. On the 4 hour time frame on Wednesday, here's the fair value gap. Price retraced to the fair value gap, led to higher prices for price to fill in this higher time frame fair value gap. So you stick to the 4 hour trend, so the trend is invalid before you look for another setup on another time frame. Now, there was even a news on Wednesday during the during the New York section. So if you look at the time, if you go to your forexfactory.com on the 15th, there was a high impact news at 8:30 that led to higher prices before this retracement. You can see the retracement after the 8:30, so it's better for you to avoid this impulsive move because in most accounts they wouldn't even allow you to take trades like this. It would be a violation to their trading rules. So price the retracement, 4 hour fair value gap, shift to market structure, retracement. I think this would have been a 15-minute fair value gap. There was a 15-minute fair value gap within this price range from the swing low to a swing high that price respected between the range of 3 a.m. 3 a.m. to 4. So I think there's a fair value gap. I just need to go to the 15-minute to confirm. So 3 a.m. to 4 a.m. Price created the first fair value gap and your stop will be at this low. Well, I'll be looking at the 15-minute time frame. I told you guys you can still look at the 15-minute time frame, but if I were to use here as an entry, I think it will be around maybe 1 to 2 for price to fill the fair value gap. But I mostly look for the best entry within those time frame. I try to filter between both time frames, and sometimes I mostly stay patient when price is in my entry level to look if I was to wait for price to trade more lower, because if I were to measure the swing low to the swing high, the 100% mark would be at this for price to fill this fair value gap completely. And I think that was what I used in this trade because I actually executed most of this trade. So that's why it was easy for me to identify it because I already traded it before on my trade plan. I just go through my trade plan and look on where I wrote on in my journal. I do journalize on the kind of trade I enter and what was the weekly candle, if it was a reversal candle, trend continuation, and counter trend. So I looked at the last counter trend trade I took, and this was the trades I executed earlier. So I think I used the 15-minute fair value gap because of the stop loss was very high, was very wide. So I used the 15-minute fair value gap around this price range. So let's go to the 15-minute fair value gap. Okay, you can see the 15-minute fair value gap. Price open. Here's the fair value gap. A retracement to the fair value gap. And this was my entry. Stop at the swing low. And here's the fair value gap. Led to higher prices for price to fill the fair value gap from the 4 hour time frame. And It is a 3.4 hour trade. So a 3.4 hour trade, and so throughout this week, I took one losses and two wins, which I already identified after the 4 hour shift in market structure. So you can do your back testing. I think most of you still have access to view this chart. So on Thursday, I wasn't looking for any entry because of this retracement after 8:30. Price traded lower, traded through this swing low. That cut off my trend, my counter trend entry, looking for an entry because I told you guys the counter trend is one of the most complicated in a way that if you don't understand market structure correctly, sometimes the counter trend doesn't last. It just retraces to a major liquidity, like what price did, retrace to this 4 hour major liquidity to fill the liquidity that led to a consolidation in price. So avoiding consolidation in price, I just stick to the trend. Once price trades against the trend, I just wait for price to align back to the buys before I look for any entry. And that was how I didn't actually look for an entry on Wednesday and no, on sorry, on Thursday and on Friday. But there was still intraday setup on the daily time frame, which was a buy from here leading to this high after running at the previous day low on the dollar index, and there was an SMT on Euro USD, which I'll talk about SMT on further lectures. But for now, let's take to the basic and easy to follow strategy or trade plan. So price kept consolidating. A few intraday setups led to this intraday setup led to this higher prices before this retracement. But make sure to do your own back testing on counter trends where you identify counter trends. Remember, you need to see price run at the previous candle's low or previous candle's high. Unless price already run at the previous candle low and high, then in a scenario where price already run at the previous candle low, like in this scenario, the next weekly candle, I'll be anticipating an up close candle because price is doing a retracement to the liquidity void from the weekly time frame. So I'll be anticipating a trend continuation. Not much of a trend continuation, it's still a counter trend, but if you apply the rules correctly with the 4 hour time frame, on the next week you can execute on the trade setup. Looking for a continuation, run out the liquidity before leading to higher prices. Let's see if price did trade to that swing area. Okay, I think price did trade to the area. But I wouldn't be going into much in depth on how price traded to the area. But you can see how price came back to this fair value gap, which would have been your entry after being patient enough to wait for price to tip its hands to you. Price did trade higher, retracement, fair value gap, respected the fair value gap, trade again, retracement, fair value gap. And you just need to be patient enough to wait for price. Price came back, took out the swing low, but let's see if price did trade it to the high. Okay, I think price did trade to the high. And make sure to do your own personal back test on all this in order to understand price more better. But I just show you what you need to wait for when you trading a counter trend to catch the low or the high of every individual week. You just look for the shift. You just wait for the shift in market structure on the 4 hour time frame. Then you look for your entry at the fair value gap on other block. If you notice, most of this example, I'm using only a fair value gap. I'm not pointing out the other block on the 4 hour time frame because you can stick to either of them. They are still the same if you know how to apply it correctly. Just look at both of them. Make sure you mark out your order block and the fair value gap. There's some cases price will do a deep retracement to another block. So we talked about the counter trend, the weekly counter trend candle. Going into the next lectures, we're going to dive deep into the daily candle types. I think it's still the same. We still have 3 daily candle types to anticipate, either a reversal daily candle, a trend continuation daily candle, or a counter trend daily candle. That's what we'll be talking on the next lectures. So that's all for this lecture. See you guys in the next lecture.